All right. Good afternoon, everyone, and thank you for joining us for our third quarter 2020 economic update and financial markets update. Today, you're going to hear from Roy Williams, John D'Angelo, and Paul Esposito with Prestige Wealth Management Group. We still have a few stragglers joining now, so while we're doing that, we'll just do a little housekeeping. Just a reminder, there will be a replay available of today's webinar. And also, we will not be able to take any live questions during the webinar today. But if you do have any questions, please feel free to email us at pwm@prestigewmg.com, and we'll be sure to follow up with you. With that, I'm going to pass it over to my father, Roy Williams, to take it away.
All right, welcome everybody. First off, let's go through the agenda. We're going to talk about the economic trends in the third quarter, the pandemic risks. Obviously, as we see now, the numbers are creeping up. Discuss the equity and fixed income markets. This is the first time ever we're going to really discuss the election, but we're not going to discuss, by party and any recommendations. Our recommendation is vote for who you believe would be the best president, former Vice President Biden or President Trump. That's, the best way to show that you care, and the best way to, influence is getting out there to vote. But all we're going to talk about, we're apolitical here. We're going to discuss, because the biggest question we've been getting is what kind of impact will the election have on the markets? And we'll discuss that today, and some financial planning opportunities. First off, our hearts goes out to those individuals who lost their jobs because of the COVID pandemic. We're seeing unemployment obviously went to over 15% and has now come back down, but still there have been a lot of individuals affected, and our hearts go out to you. As we look at unemployment, John, we've never seen such a decline like we've had in terms of, people going back to work. First off, we never had the economy shut down, as we were discussing yesterday.
Yeah, I think piggybacking off of the last couple of times that we've spoken through webinars, this is unprecedented, where you have a shutdown like this. It was unprecedented getting the actual spike in unemployment that we got. And of course, with the reopening of the economy, a lot of those jobs have come back, so we've started to see unemployment start to come down substantially.
And Paul and you and I were discussing, if we took out the devastated industries of travel, entertainment, hotels, and obviously a lot of small businesses, you walk down Main Street of any town, and half the businesses are shuttered and most likely won't come back. And again, that's horrific. But we couldn't gauge that, but we can only gauge taking out those three industries. What happens to unemployment numbers?
Well, that's what I think is very interesting. So, we did a little bit more deeper dive into the numbers. So from February until September, when we look at non-farm payrolls, we lost 10.7 million jobs. And if we look at the affected areas, Bureau of Labor and Statistics has a very funny way of categorizing some of these, but the two areas that stood out the most, mining and lodging, where you've had a 14% decline in non-farm payrolls, and of course leisure and hospitality, where you had almost a 23% decline. Obviously that decline was far worse in March, April, and May. We're starting to rebound as the economy is starting to reopen. But when we look at the unemployment rate, so this is a bit dated. This is August unemployment print of 8.4. September's, which was just released, is at 7.9. So we're starting to see that U3 unemployment number still come down. But those two sectors still, mining and lodging and leisure and hospitality, still remain problematic. And if we were to back those out, that accounts for over 30% of all the jobs lost thus far this year, which I think shows the symptom of the situation being COVID related, stemming mostly into travel and hospitality.
Back to what we talked about last time, where there you talk about the areas of the economy that are the winners versus the losers. You have digital companies that thrived through COVID, you know, the stay-at-home companies, so to speak, and a lot of these traditional, you know, cyclical companies that are important to the economy have struggled mightily, whether it be brick-and-mortar retail or some of the other sectors of the economy that you've talked about.
And there still has been a peripheral effect. I mean, if you look at, you know, some of the other sectors, construction, manufacturing, there have been 5% declines in non-farm payrolls there. But still, if we were to back out those two, you know, most beaten up sectors, the unemployment rate right now would print something closer to 6.5%, as opposed to
which is not far off from the historical average.
Right.
So, and I think that also speaks to, you know, what we're going to discuss next, you know, the global, you know, PMI. You know, if you look at the financial crisis, you know, obviously you see a V, but not nearly as tight as the V we see now. You know, and I can tell you just from looking at going to the mall on Sunday, it was so crowded, I was uncomfortable. I left. I walked in, looked around, and saw how crowded it was, and I walked out. So, you know, manufacturing and PMI are coming back, Paul.
That's correct. Again, these prints are not as, you know, up to date with the September figures, but the last time we did our Q2 webinar, we were just about to breach the 50 mark. So anything above 50 is expansionary for both manufacturing and services. Anything below is contractionary. So right now, we're actually manufacturing PMI has ticked up further to 55. Services is back up to 57. So we've had another gain. Now, you know, and this certainly corroborates with, you know, what we're seeing out in the housing market. You know, you're seeing home prices on a year-over-year basis up double digits in most regions.
John, we were just talking about Jersey Shore. You know, we have a client that was going to upgrade his home, and meaning to a little larger home because now having multiple grandkids. And before it was like 150,000. Now we're looking at almost 400,000.
Yeah, I mean, what we've seen is a surge, I think, of new home buyers that are coming from the cities and they're moving to the suburbs. I think that's probably a reflection nationally of maybe some habitual changes that are a result indirectly of the pandemic.
Yeah, the suburbs are in vogue right now, and everybody wants to be in the suburbs. But, you know, I was talking to a client today. I think the cities will come back as we get global travel and everything comes back as we go through 2021. You know, I think, you know, a lot of it will continue to come back. But, yeah, that's what's different about this recession. If I look at the, you know, 87 to, you know, 90 recession, you know, housing got crushed. Then you look at the early 2000s recession, you know, housing, you know, maybe didn't get crushed, but was impacted a little. This time, housing prices have gone up and demand has gone up. And we're also looking at interest rates at 2 3/4 for 30-year fixed. So this is a 5-star tip. If anybody in your family has a mortgage and it's over, you know, close to 4%, go on Quicken Loan, and you should be able to get close 2 3/4 to 3% for traditional mortgages on primary residences. So a lot of, you know, people, you know, ask, well, how can the economy come back so quickly in light of having an economic shutdown and unprecedented unemployment for a short period of time and continuing high unemployment? How can the economy come back so quickly? And Paul, you know, we talk about it, it's all about the Fed.
Well, that's the predominant driver. Again, it was the predominant driver last quarter. The Fed still remains very accommodative. The level of their balance sheet expansion is expected to persist for, you know, well into the next few years. More importantly, their interest rate policy is probably going to stay at 0 at the Fed funds level till at least 2023. And a very interesting, you know, telegraphing by the Fed and many of the Fed presidents as of late is pertaining to their inflation targeting figure. In the prior, the economic cycle that we had, the Fed was targeting this 2% number, and at the expense sometimes of being able to sustain growth. I think they were a little too hell-bent on that figure. And this time around, I think they're going to be a little bit more patient, which is why they put a range. They put a 1% to 3% inflation range, which is interesting in that it could have some effects of short-run inflationary bursts in the economy. But I do think it is foretelling in that the Fed really is trying to welcome inflation, as opposed to being staunch and guarding a 2% inflation
also
rate.
it's a very large contributor to why we've seen the recovery in asset prices through the summer. Because a lot of clients may be confused and scratching their head and saying, "Wait a minute, unemployment's really high." A lot of people are out of work. The economy is in the dumps for all intents and purposes. How in the world is my 401k making so much money? One of the key drivers to that is the liquidity that's been provided by the Federal Reserve. And, when you have interest rates at zero, when you have 10-year Treasury rates down around 0.5%, that drives liquidity into equities and into asset prices.
And we have to be careful here because obviously the impact of COVID, you have Great Britain having partial shutdowns now. France, I read today, may institute further shutdowns because, again, the spike in the virus. As we talked about before, yields are expected to stay, down. And the Fed has a conflict of interest, right? They want to keep interest rates down because if you look at their balance sheet, they have to pay interest on a significant amount of money. They expanded it by $3 trillion, John, we're discussing.
Right.
So, let's talk about, pandemic risk because this is something, we've never experienced in our lifetimes, be it if everybody was born after 1918, which I think it's safe to say everybody has. Most of us, it's our grandparents, and some of us, it's our parents, experienced the Spanish flu. This is something, the good news is, Paul, we were talking about the therapeutics and which we're going to talk about next, but they're able to deal with it a little bit better, the virus, and people aren't passing as quickly from the virus.
That's right. I mean, if you think about where we were back, all the way in, March and April into where, we started to see an exponential growth in cases, obviously, increased testing contributed to that. But, we didn't have the knowledge that we have today. We didn't have, some of the interim therapeutics that are available. It was expected that, from a seasonality standpoint, that we would see an uptick as we approach fall and then winter, which we are. As you can see, chart to the left, daily increases, we're starting to see an uptick. But again, not anywhere near to where we saw, in May and June, at least for the U.S. But if we look at fatalities, and I think that's, and again, this is not to downplay the severity of the virus, because I'm pretty sure we know one or two people that have been affected by it. But what is important, because there have been advancements in, the treatments, also people being mindful of social distancing and what have you, we're not seeing an exponential spike in casualties, which I think gives confidence to, most consumers. It's going to, maybe give more confidence to the economy overall.
Well, but we should take a moment, though, to, I know we've talked a lot about the improvements that we've seen in unemployment, the improvements that we've seen in the economy, post this big period of COVID. But, it's important to note that because there's so many people that are out of work and so many businesses that are struggling, I know we haven't touched on, the stimulus package that Congress is looking to pass, but there's still a need for additional stimulus in order to keep the economy rolling.
Yeah, and right now, when we look at the vaccines and the pipeline, and we've had, and we expected this. We had Johnson and Johnson and Eli Lilly, take a couple steps back in their trials, and they're going to review. They had some challenges, somebody getting sick, and they're going to review those cases before moving forward, which is the responsible thing to do. But you do have a lot of companies working towards vaccine. I'm more excited about getting a therapeutic. John, you and I were talking about
right.
This virus is going to be around even with the vaccine. Most of us get flu shots, and the flu is still here. And I read an article today. They hope, even with the flu shot, that you reduce your risk 50 to 60%. So the hope is that they get therapeutics,
right,
to help us, get over the virus.
And I think it's pretty prevalent. If you look at the amount of human and intellectual capital that's being thrown at this, we've got
worldwide.
Right. Well, I mean, this is right now 44 vaccines in the human trial phase, which is very impressive given the short period of time. You've got 5 approved already for limited use. I know there's a couple others. Regeneron is trying to get on the emergency use for the FDA. So, the big picture here is there is a light at the end of the tunnel for this, which is why markets are also starting to discount that. Certainly it doesn't look like we're going to get back to a state of normalcy, in the first half of 2021, but looking out into, the second half of 21 and 2022, as, we do get these therapeutics, we hopefully do get some sort of a vaccine, that is going to instill more confidence.
Without question. I think it's all about being able to have a vaccine and a therapeutic so people aren't passing, and then we'll go back to, John, you and I were talking going back to the normal lives that we have.
right.
Paul, when you talk about economic activity, returning to pre-COVID levels, where are we right now?
So for the most part, so what this is, it's looking, chart to the left hand side is the Economic Mobility Index tracked by Google. Chart to the right is also the same, but emerging markets as opposed to developed world economies. And what it does is it basically tracks all GPS movements and mobile devices, in particular, into retail and recreational areas. Obviously, with the forced lockdowns, you saw a very steep drop both in the developed market world in March, April, and emerging market worlds. And we've seen a very, very steep recovery since then. Now, we're still broadly, most are still slightly below where we were back in February. And obviously, if you look at the chart to the right, the EM economies, India in particular, is still 40%, below its February levels. But it's very, it brings me, a greater level of confidence that we're starting to see those numbers move in the right direction and not stagnate.
Yeah, which is, I could just see it in the traffic out there. I could see it in the, like I said, when I went in the mall, it was so crowded, I turned around and left. I could see it in restaurants. People are being significantly more active, which will help support the economy. And we talked about, John, the stimulus, you brought it before. The last stimulus really helped us not really take a bigger step back economically, because unemployment in New Jersey, people could earn over $1,200 a week, depending upon their income level.
Right. Yeah. The first stimulus package, when you put that alongside what the Federal Reserve did back in the early spring, certainly provided a springboard to allow the economy not to collapse into.
And helped a lot of small businesses keep their employees.
Correct. And I think this chart is a reflection of, human behavior. When people are on a forced lockdown and those lockdowns are being rolled back, people are habitual. They get back into their habits. This is kind of a reflection on some of the other charts that we've seen where, as things open up and reopen, the economy's wheels begin to to turn even globally. So it is an encouraging sign.
You know, when we look at the equity markets, and here, let me say this, we're only looking at the S&P 500. If we look at other sectors of the market, which we'll talk about, you really don't have the same valuations. But we talked about, you know, trading at 21 times next year's earnings. You know, yes, you know, some people are saying it's expensive. Some people are saying it's not sustainable. But, you know, we were talking, John, that we're in a period of economic recovery, which means earnings will increase.
Correct, and we're also in a period where interest rates are tied to zero.
Yeah.
So the combination of those two factors allows for companies to trade at premium valuations for what they may typically.
Yeah, but even speaking to that, when we look at value stocks, people forget that small cap value is down over 15%. You know, large cap value is down, you know, after today, I think close to 10%, 9-10%. Mid cap value is down 12-13%. So this is all a bit about, as you were saying, John, earlier, tech and growth.
Yeah, I mean, mega cap. It's hard to get a real true look at some of these valuation metrics because, you know, if you strip mega cap tech out, you know, the valuation numbers plummet. But if you strip mega cap tech out, the earnings and the revenue numbers plummet as well. Yeah. So it goes back to that, you know, the marketplace is pushed this digital revolution forward, but a lot of these traditional sectors are lagging, sorely lagging behind still.
And they won't go away, the traditional sectors. And at some point, you know, as happened in 2012, where tech lost and financials were up over 20%. You know, there are rotations that happen as we go through economic expansion from a sector standpoint. So it's important, you know, the point here is that, you know, no matter how bullish you are to stay diversified, we don't know, number one, if they're going to close the economy again, if the therapeutics will keep the economy open and we continue our recovery. So there's a lot of unknowns right now. And so it's important, again, that you have the right allocation for your situation.
Oh, and I think, you know, getting back to just more broadly the PE metrics that, you know, a lot of people have been contesting has been, you know, grossly overvalued on a forward basis. You know, there's a couple ways to solve that, and one is with earnings and you know, earnings increasing. So as earnings increase, and let's just say prices moderate but don't go up as drastically, PE multiples will actually shrink. They won't go higher. So the market at this point is, you know, sort of having its.
Well, I think, you know, with a vaccine or with a potential therapeutic, when people are no longer afraid to do certain things, you know, I think you'll see that some of those areas of the economy that have lagged start to pick back up as well.
No, from a cyclical basis, I agree with you. And you know, looking at, you know, 2021 earnings into 2022. You know, on the low end, 2021, we're expect to match 2019 earnings. On the mid-range, we're supposed to be at about 165, which is, you know, going to be a little bit higher than, substantially higher than this year. And then going out to 2022, we're expecting earnings to go out to 180, which is, you know, about, you know, over a 20% increase. So
let's say one thing about these projections, they're always wrong. They could be better, meaning earnings, you know, the economic recovery can be better because, as John pointed out, the stimulus than what's projected, or you can have the virus.
Yeah, how many unknown factors?
You know, there's other factors.
So many unknown factors. There's so many shocks to the system that occur that are unforeseen. Right. We were talking about this in first quarter when we first learned about COVID. Like, these are things you can't plan for.
No.
And, you know, nobody has a crystal ball. Nobody knows what 2021 holds for certain. You know, and, you know, sure, it's possible that, you know, we could have a second wave of COVID.
Yeah, and a lot will be controlled by COVID and stimulus as we go forward. You know, interest rates, I just want to point out, interest rates are low and we expect them to stay low. But again, if you have anybody in the family who needs to refinance, now's the time. Also, now's not the time, as Paul alluded to, the whole 30-year debt. We don't expect interest rates to go negative in the U.S. So this is not the time to go real long term because your losses, Paul, can be exponential.
Well, it certainly can be. I mean, we decided to, get rid of all of our long-term Treasury debt just because yields are no longer in our eyes that compelling. I mean, at 0.7% is where we closed the quarter at 10-year debt. The other areas of the bond market may not seem, as robust as they were 2 or 3 years ago, but the yields comparatively on a global basis are still extremely attractive.
The U.S. is still the best game in town.
We're the highest yielding debt, the safest highest yielding debt on the global block. Now, are there some sectors that have, juicier yields like convertibles and high yield? Yes. Do we have those? We do have some exposure, but the importance of bonds, I think, is still not lost in a low rate environment. And they still play a very important part of a well-diversified portfolio. I've had conversations with a number of clients saying, well, with yields so low, should I abandon bonds and just go all into stocks now? And the reason behind that is this column here, which is correlation to the S&P 500. Broadly, most of the bonds sectors that are going to be well-diversified and not behave like stocks are going to have a lower figure, something
I think the important thing to note about that, or the easy way to speak to this, it adds some risk control to an asset allocation or to your portfolio. It adds some ballast to the portfolio, so if we did get a shock to the system, we wouldn't see, some massive change to your portfolio value, or at least to the degree as if you didn't own any bonds in your portfolio.
Let's talk about the election now. Which is honestly, all the advisors, Mike, myself, and John, it's probably the biggest question is what's going to be the impact of the election. Again, we're not picking any winners, losers, or anything. These are just the facts in terms of market performance. Well, this chart, even though it seems busy, it shows over 2 years it can have an impact, which party is elected. But over 4 years, it was astonishing, John, when we were discussing this, how tight the returns were. And this is going from 1950 to present. So we had another chart, believe it or not, that went back to what,
1789.
89?
I don't know how much relevance was there in that, but
right. This, to me, 1950 to present has a lot of relevance. So, looking at if we have a Democratic sweep or a Republican president with a divided Congress, and this just shows you what happens the next 2 and the next 4 years historically. We're not trying to in any way predict what's going to happen in the future. We're not going to try and predict who's going to win the presidency or what's going to happen in Congress. But this just shows you that it's very similar.
And I think, Roy, the big takeaway from here is, yes, short run, what's one of the big, looming risks? Do we have a contested election? Sure. In the short run, that could certainly be problematic for pricing. But, in the longer run, we do strive to be very, long-term in our viewpoint when it comes to investing here for all of our clients' capital. Looking at, what's going to happen over the next quarter, 2 quarters, I don't know if that really adds a ton of value, but if we look at
the chart proves out that the most important thing is to be invested
and have the proper allocation, because we don't know when COVID ends. We don't know when the stimulus is passed. If you look at the market today, the market was up and then turned negative because of the stimulus. The second stimulus not going to get passed.
The last presidential election, we were on the phone in the middle of the night because we thought that the market was going to be down, and it turned out that the market was up by the morning. So, those emotional knee-jerk reactions are how you get yourself in trouble.
And the second question we have is, what happens if taxes are increased? And this just shows you in terms of, in history, what has happened in terms of, again, we're not predicting, we're not trying to give any insight to the election, we're just trying to give you facts of what happens. in terms of if taxes are increased.
Right. And Roy, and I think, regardless of which party gets elected, which holds the White House, controls the Senate, there are other forces. We always want to remind investors there's always other forces at play. There is fiscal policy that can be conducted on a bipartisan level. There is also monetary policy. The Fed, let's not forget the Fed, and their influence on the money supply. So, yes, in a vacuum, you could argue one way or the other, yes, there is a strong importance of one party versus another over the short run. But when you put everything together, when you put the fiscal and the monetary policy, these tend to be a little bit more muted. And we also have to look at secular trends, in the economy as well.
Also, it shows the importance of the fundamentals of the actual companies themselves. So companies are very resilient. They understand, they're very mobile as well. If taxes increase,
managed in a high tax environment.
Exactly. They change gears. They learn how to operate in that environment and earn the appropriate profits, which is why this chart shows that whether taxes are increasing in a given year or not, more often than not, companies still continue to perform.
Yeah. Okay. Let's look at, with everything going on in terms of the economy, let's look at some opportunities. We talked about a few times refinancing. If you have a mortgage, locking in between 2 3/4 and 3% for a 30-year loan, those are they are the lowest rates we've ever had in modern history for mortgages, 30-year mortgages. Also, if you or a family member have had job losses and early in the year and you have significant reductions of income, it may give you an opportunity for Roth conversions. I warn those individuals over 65, and when you do Roth conversions, you also have to take in consideration your Medicare cost. Good news today, Social Security is going to increase. I think it was 1.3%, for next year. So your checks, if you're over 65, will go up 1.3%. But again, your Medicare costs can go up from $146 to $400 a month for as a husband and wife, each of you, over $400 a month, depending upon how much you do in a conversion, and there's different brackets. So if you want to look at that, please contact us. We're happy to run an analysis for you, whether it makes sense to do a Roth conversion or not. And also depends how much money you have. If we have a few clients, 4 or 5 that are in nursing homes, and their medical expenses are $120,000, $130,000 a year. So they're paying almost zero federal income taxes when the money comes out of the retirement accounts. So again, we need to look at the big picture as we go forward. And
also important to note, Roy, when you bring that up, you think about a 1.3% increase in Social Security. That's why it's so important, when you think about having an appropriate plan when you think of retirement, and that you have consistent retirement savings.
Yeah, you need to have, a long-term strategy, and you need to make sure your liquidity needs you have in cash, so you can survive. Your rainy day fund should be in cash. It shouldn't be in the high-risk stock. And again, risk management is key as we go through these different cycles and rebalancing opportunities. That's what we'll look for as we go forward, rebalancing. If we do have a correction because we have a contested election in January, we'll look at rebalancing and buying equities, when they're down at a discount. Or if the market rallies as it did last election, we may be selling some equities to rebalance, to give you the income that you're going to take from the portfolio for next year. Also, as a reminder, if you're over 70 or 72, that minimum distributions, as we know right now, will take effect again next year. So something to look at. And this is tax planning season. If anybody hasn't had a tax plan done and may want to take a look at if there's any opportunities, please give us a call also. Again, we want to thank everybody for their time, and we look forward to having another webcast as we go forward and discuss what happened in the election. All right. So everybody have a great day. Stay safe, stay well. And if you need any supplies, we have plenty of supplies here. Masks, sanitizer, wipes, we do, and we're happy to help our clients in those areas. Have a great day, everybody.